How many winners do you think they could be in crypto? Was it one token? Like, why not just own Bitcoin versus dabble in anything else?
Yeah, I think there will be thousands. And we don't think it's a winner take all universe. We think it might be winner takes most with some sort of power law. But it's a function of market size.
Well, let's go ahead and get started. Thanks everyone for joining. Again, Clay Gardner, co-CEO of Titan, here with Avichal Garg, managing partner of Electric Capital. This will be a 30-minute call, roughly. We're going to keep it very informal, keep it very back and forth, not too much of the standard interview. But before we get started, just a little bit of disclaimers. None of what we're about to discuss should be construed investment advice. Obviously, past performance of any strategy is not indicative of future results. And if you have any questions on those disclosures, you can find those on our website. But yeah, let's go ahead and get started. So Avichal, again, thanks for joining. For those of you who don't know Avichal, he's an incredibly successful serial entrepreneur. Used to be at companies like Google and Facebook, which actually acquired his previous company. He's an investor in crypto projects, which is why we're excited to chat with him today. He's invested in companies and projects like Anchorage, Bitwise, Bitnomial, Lightning Labs, Kraken, Near, the list goes on, as well as companies like Airtable, Boom, Supersonic, Color Genomics, Cruise, Figma, Nova Credit, Notion, and so forth. So super excited to pick your brain today, Avichal. For those of you who don't know, Avichal was one of our mentors back in Y Combinator in 2018. He's been an investor in Titan, an incredibly helpful advisor over the last few years. So I lean on him heavily for all things company building and more recently crypto. Maybe a good place to start, Avichal, is I'm always fascinated to hear what people's aha moment was when it comes to crypto. You know, people hear the word crypto, maybe they read a Medium article or something, they read the original Bitcoin white paper, they start to pull those threads, and then it feels like they go down this rabbit hole, and at some point it hits them. It sinks in how big of a game changer it can be. Curious what that moment was for you.
It's a great question, and good to see you. Thanks for having me.
For sure.
Excited to chat. And thank you for all the kind words. It's very nice of you. Yeah, well, I don't know if there was a single moment for me. There's one or two that I remember very vividly. One was, must have been 2016. I saw a talk with Vitalik where he described Ethereum. And so I'd been in and around Bitcoin for a while, and my co-founder Curtis and I, we'd sort of been dabbling with it for a few years. And I saw this talk where Vitalik talked about this world computer and the ability for not just you to be able to take money and secure it on the blockchain, but to be able to do stuff with it and program around it. And for whatever reason, the way that he described it, all of a sudden this like light bulb went off in my head, and I said, oh my God, this is actually not just this money. It's actually a computational platform. It's actually a new way to write code. And just one of the killer apps is the ability to custody money. And that was a pretty big sort of light bulb moment for me to sort of get my head around just what was happening and the potential of it. And then the second sort of big realization for me was in 2017, where there's this raw energy in the crypto space where you could go into a chat room and have a conversation. And there was a lot of sort of speculative, kind of things happening that were the ICO boom kind of had its pros and cons, obviously. But there were also a lot of groups in Telegram or Discord or forums where you would go in and you would have a conversation with somebody who was just a handle. It would just be like at something, right? You didn't know who that person was. You didn't know what their degrees were. You didn't know where in the world they lived. But they were extremely intelligent, and they could talk to you about cryptography or economics or finance. And you could have these really in-depth conversations with people and just had no idea who these people were. And I remember thinking that I hadn't had that kind of an experience since the early internet. And I was too young to really take advantage of Internet 1.0. But I remember being young and being able to go into a chat room and sort of the magic of nobody knowing who you were, and sort of the rawness of that. And to me, it was the first time I'd sort of felt that since the early internet. And so I said, there's this sort of market potential, and then there's this raw energy in this space. And when you get that much raw energy from that many talented people in a place, like usually something really interesting is going to happen. And so every time I've made a good decision in my life about where to spend time or where to invest, it's almost always just been follow where the smartest people are and just hang out with them. And then something magical and interesting happens. And that's kind of what crypto felt like for me. So yeah, it wasn't a moment, but it was sort of this like realization in 2017 that all of the smartest people I knew were basically here. And so I should just go hang out with them.
That's amazing. It's a good segue. Tell us about Electric Capital, like a little bit about what that entails and how you stumbled upon, managing obviously crypto funds for many very smart, very wealthy people.
Yeah. So Electric, just as context, we have a series of venture funds. We invest in early stage, like seed, Series A investments. We do equity. We do things that are going to emit token networks. We kind of do full spectrum. And the way Electric happened was in 2017 when Curtis and I were just spending all of our time in this space. We were getting all these inbounds from traditional VCs, like people who had invested in our companies over the years, or people who with whom we'd worked as investors or in other capacities. So they were all reaching out and saying, "Hey, I remember you guys telling me about this crypto stuff years ago. Is it real this time? Like, should I buy some Bitcoin? Should I buy some ETH? What's an ICO?" And so we were doing all this sort of education in 2017, and by the end of 2017, most of the traditional VC firms had kind of figured out they weren't really set up to do crypto. Other than really Andreessen, who has their crypto fund, because Chris Dixon was so early to this stuff, and Katie's phenomenal. But other than Andreessen, there weren't really the traditional VCs who understood this stuff and were willing to jump, both feet in. And so a few VCs approached us and said, "Hey, can we just give you guys money? Can you just do the crypto stuff you're doing with your personal investing, but do it with our money too?" So these were the general partners at some of the top VC firms. And Curtis and I discussed, and we said, well, we never really set out to be VCs. So I kind of describe ourselves as accidental VCs. I mean, our life goal was not to start a venture firm. We thought we would actually start another company. And we talked about it and said, this might actually be a sort of half company, half VC firm, because a lot of what you have to do this well is you have to go pretty deep on the technical stuff, or, actually most of our team is engineers. So we spent a lot of time building software to run the firm. So like, how do you know what positions you have, or how do you know where your assets are sitting? Or, we actually run nodes to do staking and generate yield on these assets. So there's all this stuff that we have to do that requires us to build software. And so we said, we're just spending all of our time here. It'd be great to have some sort of capital base, and then we can hire more people and actually support the founders that we're investing in, and try to be helpful to them and actually invest in software. And it feels a little different than a traditional VC firm. Like, it's not so much about hiring an operational team and associates and principals. Really what you're going to end up doing to do this well, at least the way that we wanted to do it, was to hire a bunch of engineers. And so we said it kind of is like a hybrid between a startup and a VC firm. And so that's a good fit for us. And one of the lessons we learned too, our first startups were in the 2008 bubble. And so I always joke that one of the lessons we learned in that era was that if people are knocking on your door and they want to give you money, like, you're onto something. And that's kind of the beginnings of product market fit. And so you should probably take the money. And so as entrepreneurs, like, people were showing up and they were basically saying, "Hey, please, here's money, like, take our money and do whatever you're doing with it." And so to Curtis and I, that sort of sniffed like product market fit, and we should probably take the money. And so that was our first fund in 2018. And since then we've scaled it up quite a bit. And so now most of our capital base is U.S. university endowments and large hospital foundations and really great nonprofits, basically.
Mm-hmm. That's super helpful and fascinating. And I'm sure as you went down that rabbit hole and you've built out Electric, you've learned that crypto means so much more than what most people believe it to be, which is Bitcoin and Ethereum. And I'm curious what sorts of projects, tokens, exposures you find most interesting in crypto, whether it's DeFi, community networks, fintech, payments, and so forth.
Yeah, all of the above. Maybe this is a good place to segue into kind of how we think about the world. I think, in crypto, there are kind of two worldviews, and they're complementary. They're not in opposition. One worldview is sort of this top-down economics, finance sort of worldview, which is, there's quantitative easing, there's all this money printing happening, there's inflation, or maybe not, depending on who you talk to. And so you have this idea of like sound money and Bitcoin and like that's kind of sort of one worldview. And I think there are a lot of people that come into crypto through that sort of path. There's another way to think about this stuff, which is kind of what I was alluding to with when I saw Vitalik talk about Ethereum in 2016, was the idea that what this is really a computational platform. It's just a different way to build software. And fundamentally, the way that you build software in this space just makes a different set of trade-offs than traditional internet software. And in this space, what you have are these distributed systems that are slow and they don't have a lot of throughput, and they're kind of hard to use as a user. They're kind of hard to build on top of as a developer. But what you get, because they are these distributed systems, is you get ownership of your own data. You get privacy. Because you have ownership of your own data, no third party can change that data. So you get data immutability. You get seizure resistance in so much as this stuff might be considered money of some form. And if you think about that set of trade-offs relative to the internet, it's basically the exact opposite, right? On the internet, what you have is speed and scalability and throughput and ease of use and these great, web apps that we built that are rich. But we realize now that what we kind of gave up on the internet was our privacy. We handed over ownership of our data to these third parties. Like all of those trade-offs basically just inverted in this space. And so then as a venture investor, when you think about things that do the opposite of the previous generation, that sniffs disruptive. That's where disruption comes from. Because when you make a fundamental set of trade-offs like that are the opposite of the previous generation of applications or platforms, the incumbents are at a structural disadvantage. Like the incumbents can't just upend what they do and do the opposite of what they do because their entire business is built on that way of doing business. And so to us, that sort of started to sniff like, oh, that's interesting. That's disruptive. And the natural place where that takes you is, well, what can you do with a system that is kind of slow, kind of clunky, hard to use, but has these other great properties of being seizure resistant, and you own your own data and you get privacy. And that's sort of one observation. That's sort of a technical set of observations. There's a second observation, which is a social observation, which is at the same time that this sort of worldview that we have around computational platforms is happening, 100 to 200 million people around the world have now decided that they're going to buy Bitcoin and Ethereum and some of these other cryptocurrencies. And if you think about that as a large-scale human behavior, that's a really strange thing to do. Right? If you think about what's happening is people are taking fiat, they're taking USD, they're taking euros, they're taking yen, and they're handing it to another person effectively. And they're saying, hey, please give me some ones and zeros. Like instead of taking these dollars and buying some food with them or going to a movie, or buying a car, instead give me some ones and zeros. And so what's happened in the last couple of years here really is that as a culture, as an internet culture, hundreds of millions of people have decided that these ones and zeros have some value. And that value fluctuates obviously considerably in time, but there is value there. And so what you've done is you've bootstrapped ones and zeros as having value. So when you take these two concepts together, you realize that actually you have essentially a new form of value transfer, which has been bootstrapped through the social phenomenon of crypto. And you have this technology that is uniquely good at certain kinds of problems. And you put that together and you say, wow, actually, this is the perfect storm to solve any problem related to money movement. Because fundamentally, that's what this stuff is good at. I can send you money now across the distributed system, and I own the money on one end. And when it gets to you, you own the money, and there's no intermediaries. And it gets there in an hour. And you might say, well, an hour is a long time on the internet. Like I'm used to stuff being done in milliseconds. But actually, when you're looking at the incumbent here is not really the internet. The incumbent here is the legacy financial system. And in the legacy financial system, like if it's 3:00 on a Friday and I wanted to send you a wire, that wire may not get there till Monday or Tuesday, which is kind of crazy if you think about it, right? And so literally, like you're in LA right now, if it was Friday afternoon, it would literally be faster for me to go to the bank, get a bunch of cash, get on a plane, fly to LA and hand you the money than it would be for me to wait for the wire to clear, right? So the incumbent here is actually this like 1970s legacy system. And so to us, that's where all this stuff really gets really interesting is we're, in our opinion, just going to reinvent the entire financial system, starting with a really, really base layer of a potential store of value, the ability to sort of have money and move that money peer to peer. And as sort of, I think Ethereum has shown and other people are now playing with, once you have money as a digital 1 and 0, like a purely digital bearer instrument, you can program that. Once you can take custody of it, you can write some code around that. And the ability to write code around that then opens up all these other things. It opens up wills, trusts, escrows, insurance, REITs, HELOCs, mortgages, derivatives, like everything. If you think about the entire financial system, is just here's a pile of money, here's some rules around that money, and here's what to do with that money. Over the next 10 years, like make sure the cash moves in this way, right? And now all of a sudden, instead of that being hundreds of pages of legal documents and people on phone calls and this like legacy 1970s wire infrastructure, it's 2020s computer science with Rust code and GitHub. And like that to us is just obviously the way all of this stuff just gets reinvented. So over the next 20 years, we think all of anything that has to do with money movement is going to get consumed by this infrastructure. And then the question kind of, I think what you're getting at, to bring it back to the question you asked, is, well, how does that manifest in terms of what we invest in? And so what we invest in is layer one protocols that are sort of solving the fundamental distributed systems and infrastructure problems. We invest in DeFi protocols, things that are reimagining what all of these financial primitives around lending or borrowing or margin or derivatives could be. We invest in centralized companies because we think that actually for certain types of users, they may not want to use the decentralized version of it. They may not want to manage their keys. That there's technical complexity there, and so you'll get some really great centralized entities like Coinbase or Bitnomial or Bitwise that make that really easy for people, and they're a bridge into this world. And so on the front end will look like fintechs. On the back end, they're going to be built on crypto infrastructure, and so we'll invest in those kinds of companies. And then some of the emerging areas that we're starting to see that I think are really, really frontier but exciting are things like developer tools and open source technologies, because actually the idea here is that when you have tokens, you can have a community of people that all own a share of that network and help govern that network collectively, which is a really good fit for open source developer software. We think this could be a really good fit for certain kinds of marketplaces, digital collectibles and digital goods. Like one of the technology breakthroughs here is the idea of digital scarcity. Like I can own a thing and you can't own the thing, which just wasn't possible previously. And so digital collectibles become really interesting, and the marketplaces around those become very interesting. And so there are sort of these adjacencies that we're starting to see in addition to sort of core crypto that we invest into.
That's fascinating. I'd love to maybe move to a couple of questions our clients sent in advance of this call. Sure. Some of these are quite fun and very practical. So the first one being, if you were the CEO of a Fortune 500, or let's call it an S&P 500 company, would you potentially look to convert a portion of your balance sheet into Bitcoin? Why or why not?
Yes, short answer. I think it's still very early in the evolution of this. I think there are a couple of advantages to doing that. So one, I think you take a very rational approach, which is maybe it in fact does turn out to be some sort of inflation hedge. It's TBD whether or not that will happen. But just from a portfolio perspective, there's a lot of analysis that people have done that basically says if you add a small percentage of exposure to something like Bitcoin, your portfolio performance goes up. And so, that there's a lot of data to back this up. And so if that is true, then there's no reason to think it wouldn't be true for corporate treasury management, and some sort of crypto exposure, I think, rationally makes sense. I think there's also just the reality of being exposed to these things and understanding them, which I think is important. Like if this is the way the world is going, the best way to understand it is to have some exposure to it. Right. So imagine you're in like 1994 and you can see the internet coming. Does it make sense, even if you're not going to convert your entire business to, the website and .com and buy a domain name and switch all of your servers so that now everybody has, is working on email or something, right? Does it make sense for you to take part of your organization and start building some muscle around that, specifically your finance organization, if you think that this might be the future of finance? That certainly makes sense. And then I think there's frankly just a PR win. Like if you're just seen as a forward-thinking company and you're in the press, like I think that's part of the game, right? Like the way that the modern press cycle works is you don't go issue a press release and go talk to the Wall Street Journal and then get a write-up. The modern way to do PR and communications is to do it direct with your customers and to be in the social media channels. And I think if you're smart about it, you could actually take your move into this space as a branding opportunity and as a PR opportunity, which sort of feels like free upside. Like, why wouldn't you do that?
Mm-hmm. Got it. Next question would be, you've worked at some of the big tech companies, Avichal. You've worked at Google, your company was acquired at Facebook, you led product there. Do you think they ultimately win in the crypto space? If you think about how people have approached traditional payments, consumer products, the default is that the incumbents will win, and you see a lot of antitrust and regulatory scrutiny as a result. Do you think that same logic, the resources will drive, those with the resources will drive the value creation? Do you believe that applies to crypto with big tech as well?
No, short answer. And the reason is that I think the technology stack is sufficiently different, and the way that you go to market is sufficiently different. Like what you're trying to do in these systems, for example, is when you have a distributed system with tokens to sort of align incentives, you can't have more than one party own, let's say, more than 10% of the network, because that ends up being a vulnerability to, that's a way that the network itself becomes less resilient. The more concentration of ownership you have, the less resilient the network is. to attack. And so by design, these networks are set up to try to distribute ownership very broadly. And the successful ones have very, very distributed ownership, which is kind of antithetical to what these companies do, right? Like when you think about what most companies need to do is they need to control the network. They need to control the marketplace. They need to have control. And so when you think of it, that's just one example. But when you think of it through this lens, I think what you realize is that when you have a company and there's a new infrastructure that emerges and a new way to build software, it's not so easy for that company to just start building with that new way of software, because often the consequences are downstream of that. Like you have to change your human organization around the technology for the business to be successful. So I'll give you a concrete example, right? To put it into sort of like historical context. Think about Amazon versus Walmart. Like Amazon was started in 1994, I think. Walmart has had basically 30 years to figure out how to get a website and an e-commerce business running. And it's an interesting part of their business today, but like it took them 20 years to figure that out. And like, how is that possible? How could they not figure it out for 20 or 25 years? And it's because actually it's not so simple as just like putting up the website. Actually, what you have to do downstream of that is you have to change the way that you market. You have to change the way you acquire customers. You have to change who inside your organization has power. And inside Walmart, the engineers didn't have the power. The people who had power were, the brand managers and the people who have the Procter & Gamble relationship. And so in a historical context, you can see like in the early 90s, people thought that the big winners on the internet would be the media companies and the TV companies, CNN and New York Times and of course, Walmart. And in retrospect, we realized that just that was silly, right? Of course, it was going to be Facebook and Google and Twitter and Amazon that won, like the digitally native companies. And I think a similar thing will happen here is like, it's not just that the infrastructure has changed. It's that in addition to the infrastructure changing, well, if you natively build on that infrastructure, you very likely have to change your human organization around all of that. And changing your power structures inside a company is very, very hard at scale. And so it's unlikely that most of these companies will be able to make that transition. Some certainly will, but I suspect most will not. Which is why, I mean, on the early stage venture side, one of the behaviors that we see is all these great founders are coming in because they realize that Google and Amazon and Facebook and so many of these big incumbents are just not here. And so if you're thinking about starting a new company, being able to do it in a space where you're not competing against those incumbents and it's just mostly greenfield, that's a fantastic place to start a company, right? That is very reminiscent of what the internet was in the 90s and early 2000s, where it's just all greenfield and the incumbents weren't here yet.
Got it. I'd love to chat through a few what I call quick takes. So this is a new section we're going to try out. The first one is, what's the single most important thing about crypto you think most people are missing? And the reason I ask that is if you think about particularly some of the smartest people of the last century, let's take Charlie Munger, for example. He famously called Bitcoin rat poison. I think it was several years ago. I don't think his views have changed much. What do you think smart people are missing on crypto?
I think there's a lot, and depends on, and to be fair to many smart people, like I think it's still very early days. And so it's entirely possible this whole experiment falls apart over the next decade for all sorts of reasons. I'll maybe make two observations about things I've learned that I think run counter to what I think a lot of smart people and kind of the way that they think about it. So one is, I think if you look at some of the criticism that comes in, people will say things like, oh, it's only used for nefarious activities. Like, there's no good use case for this stuff. It's only used for, bad stuff. And I actually think that's a really bad way to look at technology, because almost always technology is adopted by the fringes first. And it turns out folks like drug dealers are underserved because, they have meaningful problems. And so actually they end up being early adopters of a lot of technology. So actually, like, I tend to think if you see people who are on the fringe that might be kicked out of the existing system, drug dealers or sex workers or let's say cannabis, some people have like moral hangups about these things. And to me, I think if you set aside the morality of it for a second, you just say, well, these are people that are smart and underserved and willing to adopt technology. And look at the history of technology. What do you see? Well, what you see is that they were all early adopters of email. They were all early adopters of the internet. They were all early adopters of pagers. They were all early adopters of cell phones. Like, I would actually look at the fact that there's some small percentage of that activity happening as almost a positive signal. That's also interesting because it's actually, I think, the thing that people like to glom onto if they haven't actually done the research to say, well, actually, what percentage of the activity that's happening here is nefarious, which actually turns out is very, very small. Like any of the third party data that you look at sort of is very clear that the amount of nefarious activity happening here is quite small. As you know, we just had this the Bitcoin ransomware attack on that pipeline, and the FBI recovered the Bitcoin. And it's because actually it turns out Bitcoin is a terrible way to try to move money around because the blockchain is transparent. And so actually you're better off using, legacy financial systems and shell corporations and moving money internationally where it's all opaque. And so actually, I think this criticism that a lot of smart people have, it's like this stuff is bad. The data doesn't back up that most of the use cases are bad. Actually, it's a very small percentage of the use cases. And B, actually, it's sort of, to me, a silly criticism when it surfaces, because a lot of times when people who are on the fringes of society are doing something, you actually should pay more attention rather than dismissing it. So it almost on like principle seems like the wrong way to look at technology.
Mm-hmm. Got it. How many winners do you think they could be in crypto? Was it one token? Like, why not just own Bitcoin versus dabble in anything else?
Yeah, I think there will be thousands. And we don't think it's a winner take all universe. We think it might be winner takes most with some sort of power law. But it's a function of market size, right? So if you look at, let's say, social networking, in the early days of social networking, you had this explosion of people that were trying to win at social because people would see it was a big market. You had MySpace, Friendster, Bebo, High Five, Tagged, Facebook. There was all of these, right? And then you did see this coalescence in sort of like the late 2000s around a couple of them, right? Facebook was a big winner. LinkedIn was a big winner. Twitter was a big winner. And so I think we're kind of right now in the 2005-ish era of crypto, where there's just this Cambrian explosion of all these ideas. Many of them are too early. Many of them will not achieve escape velocity and have real usage. And so over the next 5 years, I would expect there to be a coalescence around a relatively small number that will be big winners. But what happens after that is that the market size keeps expanding. And so actually, if you look at social post 2012, you saw a refragmentation, right? Now you have Snap, you have TikTok, you have all these other niche social networks that have emerged. And it's because the market size got large enough that you could actually support many, many more winners. And so actually, if you play it out more than 5 years, if you go 10 years plus, I would not be surprised to see the same thing happen in crypto, is that, when you have 3 billion people that are using this stuff, is it so crazy to imagine that you have thousands of tokens and you have some sort of power law with a very long tail. That to me would be very consistent with what's happened with other network effect technologies in the history of technology over the last 50 years. That's generally how it's played out. And so I would expect crypto to be very similar.
Makes sense. Maybe last quick take here on portfolio allocation. If you think about the average individual of each all, what percentage of their portfolio should be in crypto in your mind? And I realize the answer is with a strong asterisk. It highly depends on a handful of different things, but at least how should an individual think about percentage weighting in crypto?
Yeah, it's a very good question. We get this asked of us all the time. Obviously, not financial advice, and so do your own research. I tend to think that the way to think about it is a function of your risk tolerance, which is how much are you willing to lose and what does losing that money mean to you? And for some people, that's 50 basis points, 0.5% of your portfolio. For some people, that might be 1 or 2%. It's also a function of age and how much, which is sort of risk tolerance. I tend to think, though, that maybe the fundamental question to ask is, do you think it's real? Like, do you think that there's something real and fundamental happening here? And if so, what percentage of your net worth does it take for you to start paying attention to it, right? So if you do think that this might be real and this is 1990 or 1995, you probably should have paid attention to the internet because it's going to change a lot of stuff around you. And actually understanding that would have let you understand a lot of what was going to happen in business and software and technology and politics and society. And so whatever percentage it takes to get you to pay attention so that you actually start paying attention, I think is a good lens to look at it through. And that number is different for different people.
Got it. So last segment here, I know we're running up on 30 minutes. Let's call this long or short. And again, with the asterisk, and this is not investment advice, but just for the sake of a philosophical debate, I always love to learn which way people are leaning bullish or bearish. So why don't I walk through a couple of topics related to crypto and you just give me the one word answer, long or short?
Okay, sounds good. Sounds good.
Okay. First one, Bitcoin, long or short?
Long.
Non-fungible tokens or NFTs?
Long.
virtual real estate?
Long. I have a feeling my answers might be all long if you ask crypto assets.
Dogecoin.
Oh, that's an interesting one. Short.
Decentralized finance, or DeFi.
Long.
Last one here, Coinbase. I have a feeling I know the answer.
Long.
Okay. Avichal, this has been a real pleasure. I'm sure everyone enjoyed this. I know there's a lot of questions that poured in, so we may have a couple I can ping you on offline, but I really appreciate the time. Thanks for having us.
Good to see you. Thank you for having me. Good to see you.
Cheers.